US dollar's been on a rip recently, hitting a 15-year high of late. What's been behind the move? Well, joining us now is James Stanley from Daily FX. James, this drive higher coincides with the election of Donald Trump, but why has the dollar risen so far?
You know, that's the million-dollar question right now. Going into the election, it really seemed as though much of the world had anticipated that a Trump presidency was going to bring on dollar weakness. That was certainly a pattern that we had seen in the weeks leading up to the election. Of course, election night, massive reversal took place that hasn't quieted down yet. I think one of the big drivers here is the fact that change can be good, right? Much of what we had over the past 8 years, at least in the United States in the post-financial collapse environment, was very much the same thing. It was the Federal Reserve trying to help the economy by putting more and more Band-Aids on it via QE. With the Trump presidency, there's the prospect of fiscal stimulus. So there's hope that what we've been doing for the last 8 years that hasn't been working may change and begin to work. So we have the very luxurious combination right now of a ready, willing, and able central bank. The Fed's just now beginning to get more hawkish, but if markets collapse, if they correct, the wide thought is that the Fed's going to come back with more QE or dovish monetary policy, whatever. They're not going to let things get too out of hand, similar to what we saw in February of this year. But now we also have the hope of long-term fiscal stimulus actually bringing growth, reigniting inflation, and finally turning the corner from the financial collapse that's been dragging on for about 8 years.
The saying, "the trend is your friend," comes to mind. Is there more to come in this trend, do you think? If so, where and against which currencies will the dollar outperform?
Very good question and a really good point there, Jeremy. The trend is your friend until it bends, right? That's old trader saying. In many cases, trends can be difficult to work with because as they are moving up, they get very little pullback, and then when they do finally start to pull back, well, that's about the time that they begin to reverse. This is one of those examples where we have most factors lining up in a singular direction, which is pretty exciting. The technical formation on most US dollar charts, extremely bullish. We just broke above those 15-year highs like you mentioned a moment ago. The fundamental backdrop, we have a Federal Reserve that's been persistently hawkish now since July, and maybe even for a better part of the last year and a half. They want to raise rates. They want to normalize policy. There's a very real reason for them to want to do that in the essence of saving defined benefit plans, savers, retirees, of which we're seeing more of in the United States with baby boomers going into retirement. So it's one of those rare themes that where we could see technical and fundamental factors coalesce in the same direction. And that could lead to some considerable continuation. The big question is going to be answered by the Fed in December at their next meeting when they discuss rate hike plans for next year and thereafter. As far as areas to look, I think dollar yen, this thing's up 11.5% since the lows on election night. I think this is one of the exciting places to look for continued dollar strength because we have that monetary divergence between the representative central banks. Even if the Fed isn't going to go more aggressive with their rate hike plans next year, they're probably a lot closer to more hikes than the Bank of Japan is, where they may actually need to do more on the stimulus front. So, again, we could have that monetary divergence. Dollar CAD, also a really interesting example. Right now, the Fed's talking about rate hikes. The Bank of Canada is talking about more monetary stimulus. So this is one of those situations where we could end up with a stronger dollar, a weaker CAD, which could lead to a really nice trend in dollar CAD over the next couple of months, leading into what could be the next couple of years.
So what's the next big dollar event?
So most folks already are looking at the Fed. That's the middle of December, a few weeks away. Before we get there, we have NFP, non-farm payrolls. I think that could be a really big one. That's the last jobs print that we get before that next Fed meeting. And of course, employment is one of those big questions, one of those big issues that the Fed's been trying to tackle over the past couple of years. If we end up with a really strong jobs report, this dollar strength trend, could really get ahead of itself to the point where when we go into the Fed, we might see a little bit of pullback if the Fed's not too aggressive with rate hike expectations going into next year. Again, Fed, middle of December, that's going to get a lot of attention, a lot of interest. But I think what's more important than just the rate hike itself is the dot plot matrix, what the Fed's looking at for 2017, 2018. That's exactly what the big market driver coming into this year was. It wasn't the rate hike in December. That was 25 basis points. Nobody really cared. It was the 4 rate hikes that the Fed were planning for this year that really appeared to freak everybody out. You know, combine that with the fact that oil prices were getting crushed. China was in a very precarious state. The combination of risk factors was just too much for markets to bear. I don't think they're going to go that aggressive this meeting in December, but if they do say 3 hikes as opposed to 2, that could get a little bit of caution in the markets. If they say 4, then you know, it could be one of those situations where we're just waiting on the next piece of bad news for markets to pull back 5 or 6%.
Okay, so what's the dollar pricing in then from the Fed in December?
It's about as close as a sure thing as you get. I mean, we're 100% from most metrics. That rate hike in December is pretty much baked into the cake at this point. And, you know, I think that's a good thing because it really does get market attention away from that, you know, really hot dot of are they going to hike or are they not? I mean, they're going to hike. It's pretty much a given as far as market expectations are concerned. But like I said, the bigger factor is going to be what the Fed says about 2017, 2018. The Fed's really begun to use forward guidance as a very critical tool over the last year. For instance, we came into this year, Fed said they were expecting 4 hikes. Within a couple of weeks of that rate hike in December, markets began to collapse, equity markets, that is. Now, when they were mid-collapse, Janet Yellen had congressional testimony for her Humphrey Hawkins review in February 10th, February 11th of this year. At that point, Ms. Yellen took a very, very dovish stance with rate policy, and that's what brought life back to stocks. That's what brought on that another new, fresh all-time high in the S&P 500. I think the dot plot matrix is where it's at. If the Fed says that they're going to go more aggressive next year, then it could bring on, you know, a little bit of caution, a little bit of fear from traders. If they, you know, stay in line, as in 2 to 3 expected next year, then we could see market attention go back onto data, you know, back onto forward-looking expectations for what might enthuse the Fed to go more aggressive or more passive. But I think the dot plot matrix is going to be the big takeaway from that Fed meeting in December because, frankly, there's not many people that aren't expecting a hike at the next meeting.
James, thanks so much indeed. We have to leave it there. James Stanley is from Daily FX.
Thank you for your time, Jeremy. Hope you have a great rest of the day.